Hello traders, and welcome to today's episode. Today we're going to be talking about synthetic indices. When you come to the broker, which is derivative broker, they're only the broker that offer this kind of trades in their platform. So many people have been trading the synthetic indices, but only few has full knowledge about what synthetic indices are and how they operate. In the derivative platform, synthetic indices is one of the major uh, pairs that is being traded worldwide, and it is only on Deriv you can get this these pairs. So today I'm going to be introducing those pairs to you, what they are, how to trade them. But in this particular episode, I'm only going to tell you what synthetic indices are. So if you are new to the platform, you should have insight of what you are about to trade, because many people just trade them maybe because they have friends who trade synthetic indices, or probably they might just watch it online and they felt it is more better because of the factors involved. But today I'm going to be telling you everything regarding synthetic indices, and in the next video we'll be talking on how you can trade these pairs without losing your funds. Now, what are synthetic indices? Synthetic indices are custom-made indicators designed to copy how real markets move, but with a unique feature. They are not influenced by real-world events. These indicators use a secure random number generator, keeping their ups and downs consistent and protecting them from risk and sudden changes in the market. Now, synthetic indices are mimicking real life market, and when we're talking about the real life market, we're talking about forex, because it is only forex that we know that is real life. And why this is real life, it involves two players. It involves the buyers and the sellers. But in the case of synthetic indices, it is not like that. They are only mimicking forex in times of movement. So that is why it is stated that world events doesn't affect synthetic indices. And what are these world events? Economic, news, holidays doesn't affect the synthetic indices. And you can trade it from Monday to Friday, sorry, Monday to Saturday, even Sundays. That means it can be traded even weekends. But in the case of forex, you only trade them on working days because it involves institutions like banks to transact all this business, to transact the flow of income or money. But in the case of synthetic indices, nothing of such. So it is an indicator that is being programmed to mimic or copy the movement of the real world market. So it's more or less like a virtual forex. So we can see synthetic indices are more or less like a virtual forex. These are not real uh, markets. So that is one. Then the, we have different kind of fake indices. That means when we say fake indices, we mean different kinds of pairs which mimic forex, but they are not forex, because there are only one broker and one system making these fake indices. There aren't many of them available to trade. This is unlike the thousands of real financial assets you can trade in regular financial markets. Here are the different types of fake indices. Now, when we say fake indices, doesn't mean you can't trade them. The reason why they use the word fake is because they are not real in terms of price movement. They only mimic what those real market does. And it is only one broker that provides this opportunity, which is Deriv. And this particular pair is traded worldwide aside little or few countries which are not accepted to trade it. It doesn't mean it is risky to trade. No, that is not what it means. But it's only telling you that when you are trading forex, like for those of you who are into forex, there are times you watch a particular pair. You Before you even do the trading on that particular pair, you have to make a research if there's going to be a news on that particular pair that day, and what event are going the economic event on that particular pair. You just have to make your own research before you start trading. But in the case of synthetic indices, we don't do all that because all those factors affecting forex doesn't affect it. But that doesn't mean it doesn't make the same move. Yes, other we have the you will definitely price action is involved. So the only difference between these indices and the real market is that the real market is being uh is real. That means it's traded by humans. But in the case of this, it's a combination of indicators just to mimic or copy the movement of the real market. So if you are new and somebody is asking you what do you understand by synthetic indices, I think by now you should be able to tell them that synthetic indices are those indices that mimic or copy the real world or real life market. They are not real in terms of um, uh, movement. They move like them, but they are not real because that is why we don't have these factors that affect forex affecting them. So now we have different kinds of fake indices or synthetic indices. The first ones are the volatilities indices. When you check or you go through the derivative platform, you have numerous indices there, not really the volatilities. In fact, currently now I think it is increasing. We have recently they introduced other volatilities. Initially it was volatility 10, volatility 25, volatility 75, but now when you check, you notice that there are more of the volatility pairs on these synthetic indices, and each volatility has its own lot size. When we say lot size, on volatility 10, the minimum as of today, I think the minimum lot size is 0.50. Yes. Then when you go to volatility 50, the minimum is 0.01. So you can see a difference there. And in forex, we don't have all these kind of uh, lot size differences. It is 0.01 rand, but you might have different. The spread might be different on each currencies. But in the case of volatility, they have different um, lot size, so which might serve as a disadvantage on the other side, because if you are trading volatility 10, which is using 0.50, and then all of a sudden maybe you want to switch to volatility 25 that is using 0. I think volatility 50, which is using 4 lot size. So when you mistakenly open a live account or live, maybe you are trying to trade live, and instead of you to trade your volatility that is using volatility 10 that is using 0.50, if you eventually open a trade on volatility 10, volatility 50, which is using 4.00, which is 4 lot size, you see that if you don't have enough equity, if the price should go against you, you make huge losses. So aside that, we have volatility 75. This volatility 75 seems to be the very popular one. Volatility indices are created to mimic the up and down of real world markets. These indices maintain a consistent level of volatility, changing by predetermined percentage with each tick. For example, the volatility 75 keeps a constant 75% volatility with a new tick generated every second. Traders benefit from the fixed volatility knowing the level before it happens. Notable volatility indices available for trading include we have the volatility 100 index, volatility 300, even the volatility 75S, volatility 10S. So when you go to the platform, you see different types of volatility there that you can definitely observe, then later you decide to trade on. Then aside all this volatility, we also have the boom and crash indices. Exclusive to deriv.com, boom and crash indices like boom 500, boom 300, boom 1000, as well as crash 500, crash 300, and crash 1000 have distinct characteristics. Boom indices default to sell. That means on boom, the default settings is sell. Immediately you place a sell order, you just notice it goes on profit immediately. While crash indices remain in the purchase, that means for crash indices, the default setting is buy, but sell at sorry, while the crash indices remain in the purchase cycle, but sell at varying intervals based on market factors. They operate independently, unaffected by specific commodities, currencies, or external events. Yes, all these pairs, the boom and the crash, they are not affected by any kind of maybe either the what's it called, the external, or they are not affected by external events such as holidays and everything. In fact, in general, all the peer involved in synthetic indices doesn't have any um, side effect regarding the economy or whatsoever. When we're talking about the economy, during the pandemic, majority of the forex and traders were not happy because during that time things were so bad that many crises everywhere. People are facing this huge the the issue of coronavirus. So that really affected the forex traders. But for those who are trading synthetic indices at that period, they have no there's no fear. There's no fear because they are not it's not the real world market. So they have nothing to fear about. The trading and the system was still paying them. So for those who were affected during the pandemic were those who were trading forex majorly. So you can see that on synthetic indices there is nothing regarding news and whatsoever. So that is why major traders today, most usually the new traders, prefer trading synthetic indices because some don't have that update knowledge regarding the economic event of a particular pair. Some just want to they want to make money by all means. So they see deriv or synthetic indices as a safe place to go and leverage on. But many of them still don't have the insights of what our price is doing on synthetic indices. So today, if you are part of those people, at least by now you should be able to understand that these markets are not real. That doesn't mean you can't trade them. And secondly, if you must trade them, you must understand some particular terms in terms of trading because despite that it doesn't mean it doesn't follow the price action. So as we keep moving in this um, training and everything, you'll be getting more knowledge on what all these indices stand for and how you can leverage on them. Areas where you can come in, tap in profit and exit. That is just the idea. So we have jump indices. Jump indices assesses an index price. Jump indices jump indices assesses an index price movement based on hourly volatility percentage. For instance, jump 10 has 10% volatility and experience an average of 3 leaps per hour. The jump indices range from jump 25 to jump 100, each with corresponding volatility levels and leap frequencies. So this applies to every pairs in synthetic indices. Whichever one you see, they must have a specific unique character. So they are not the same. They might be in the same peer group, but they are not in terms of profit and losses. You notice that there's a bit different based on the volatility involved. Then step index. The step index mimics the actual market in a step-by-step fashion with an equal likelihood of moving up or down in increments of 0.10. Traders value to traders value the step index for its lower risk compared to the indices. So that is for step index. The step index also is not, it's just, since it's under synthetic, definitely it's not the real life market, but also mimic the real life market. Yes, it mimics the real life market, and it moves up and down in steps. So some people prefer to also trade it, but if you don't have a strategy in place in trading all these pairs, you might lose your income. So if you are new to this platform, you have to stick so that you see all the strategies I'm going to be explaining on how you can trade all these pairs and be profitable, because it's a different thing to trade and it's a different thing to make profit. So many traders from research, out of the 100%, out of let's out of 100% traders that are around the whole globe globally, we only have 10% making profits. The 98% are making losses. So for you not to be among the 98% that is are making losses, or 99%, sorry, 90%, let me just put in 90%. So if you want to be among the 90% that are making losses, you have to have a good strategy which you must have back tested several times. And you must also have your risk management involved. When I say risk management, understand your area of entry, exit, and where you should put your stop loss, because some people trade without stop loss. Yes, that is why they hold losing trade longer than holding winning trade, because in their mindset the market will reverse, and unknown to them the market has gone to a point whereby it's even changing the character. So if you are new to this platform, after you've gotten all this info like this, the next thing you should be anticipating for is the strategy you need to put in place so that you can trade any of this particular pair. And it will be also good if you practice only few of them. We have numerous pairs there, you can choose two, then master the way those two move, then you leverage on them. It is better to trade two pairs and make profit than trading all the whole pair and losing your money or losing your equity to the brokers. So please, it will be very very nice if you just um, stick to these principles, like as I said earlier on, so that you don't regret your action going into derivative or trading synthetic indices. Then we also have the range break indices. The range break indices simulate a market breaking out of its trading range after a set number of attempts. The range 100 and range 200 indices are commonly used, with breakout rates occurring after an average of 100 and 200 attempts, respectively. Most popular synthetic indices. The volatility 75 indices stand out as the most traded synthetic indices due to its high daily trading volume and significant profit potential. Its 75% standard deviation and frequent leaps make it a favorite among day traders, especially during uncertain market period. Platform to trade synthetic indices. While not available on MetaTrader 4, Deriv provided various platforms for trading synthetic indices. Each platform is unique, ensuring traders find one that suits their needs without missing the MT4 platform. Platform provided by Deriv include, now you see, the reason why you can't find synthetic indices on MT4 is because, one, it is only one particular broker that offers um such opportunities, and again they went as far as creating different platform within their own uh, space for people to trade all these synthetic indices without having to regret why there is no MT4. So the first platform is called the DTrader. DTrader offers a powerful and user-friendly trading platform called DTrader. This platform allows you to trade synthetic indices with options and multipliers using either a desktop computer or a mobile phone. Then Trading on DTrader gives you flexibility in managing your transactions. You can customize your approach by choosing the volatility level and contract duration. You can open position with a stick as low as 0.35, which is at least maybe 0.50 today, because the last time I checked, I don't think you can still use 0.35, and specify transaction simultaneously if you wish. Then we have the Deriv MT5. The Deriv MT5 is an all-in-one solution for CDF trading, providing access to all assets and a range of professional trading tools. This platform includes analytical objects, technical indicators, and infinite charts in various periods, allowing you to better manage your positions and funds. Only customers with a synthetic account can trade synthetic indices on Deriv MT5, accessible to desktop, computer, and mobile devices. So this one applies to those who has laptop or a desktop. When you open it, it looks something like this. Let me check my chart. This is how it looks like. This is synthetic indices. Hmm? This is synthetic indices. This is how it looks like. So you can trade all these on your MT5. For those of you who have a Deriv account MT5, so you can trade this on it. Now we have the DX, that is the Deriv X. Deriv X is Deriv Interest CFD trading platform, offering access to multiple markets and a variety of assets. It is customizable and equipped with features to tailor your trading environment, with over 90 indicators and 13 drawing tools. You can monitor your progress and past transactions. Synthetic accounts are required to trade synthetic indices on Deriv X, accessible on desktop, computer, and mobile devices. Then we have the DBots. DBot is a Deriv trading platform that allows you to build a trading robot for automated transactions. No coding knowledge is required. You can construct your bots by dragging and dropping pre-built blocks and indicators. DBot operates without constant monitoring, letting you step away from your computer without missing opportunities. You can trade synthetic indices using options on the DBot platform available on desktop computer. So these are other opportunities whereby you can trade the synthetic indices on Deriv. This one has to do with a robot which you can use either on your laptop or your mobile phone. So and then it doesn't require a coding knowledge before you do that. So when you go to under the dbot, you can go there and create your own robot for yourself that will be taking trade automatically based on your strategy setup. So this is the reason why people hardly miss the MT4 platform when it comes to synthetic indices. Then we also have the smart trader on still the same platform on Deriv. For new traders, smart trader is recommended due to its user-friendly design. You can trade synthetic indices using options on the platform, receiving payment for accurately predicting asset price movement. Smart Trader is accessible on desktop and computer. Yes, you can access this Smart Trader on your desktop or your computer. So when you go to the platform, you'll be able to select if you want to use the Smart Trader method. Those who trade binary, who love binary trading, which is either trading per minute or per hour or per seconds, they usually use the Smart Trader platform on Deriv. So immediately they sign in, they go there, because at that point you see the percentage of return you're going to make if your prediction is correct. If your prediction is correct, you will see the particular percentage you're going to be earning. So, and if your prediction is wrong, you also see your outcome. So it is user friendly, and in fact, many new traders love using it because they feel you can use minimal lot sizes. Um, you can stake as low as 0.50 cents. Yes. Then depending on the return you're going to get. So that's why I said many um many traders who love trading the binary use the smart trader on um deriv. So I think the last one is called the Deriv Go. Deriv Go is Deriv mobile app designed for on the go trading. This app allows you to trade synthetic indices with multipliers and provide risk management options such as stop loss, take profit, and transaction collections. DerivGo is available on the Google Play Store, Apple App Store, and Huawei App Gallery. So now let's talk about the pros and the cons of synthetic indices. That means the advantage and the disadvantage trading these synthetic indices. Considering the uniqueness of synthetic indices, here are the pros and cons to help you decide if this type of trading is suitable for you. Now let's talk about the pros side of the of synthetic indices. Pros of synthetic indices are all these indices have the same level of risk, making it profitable for traders. Traders know exactly how volatile the index they are trading will be. You can trade these indices anytime, any day, anytime, day or night, throughout the year. This is different from other markets like stock markets or forex, which only operate at specific time during the work week. The price of synthetic indices aren't influenced by economic factors, events like inflation, stats, or interest rates. Announcements don't immediately impact their prices. Announcements don't immediately impact their prices. Then the cons of synthetic indices, they can be quite unpredictable. Yes, it is crucial to understand their volatility as you could easily lose your money if you don't grasp position sizing and the specific synthetic indices you are trading. Then secondly, you can only trade them with certain brokers. There are only a few brokers offering synthetic indices trading, and one of the most popular EU-based broker is among them. So these are what you should just know about synthetic indices. That one, they are not a real market. Two, uh, they only mimic the real market. And then thirdly, if you are going to trade on any of these pairs, you need to have a strategy as set aside. You will need to know the advantage and the disadvantage of each um pair, because somebody who is trading volatility 75 and somebody who is trading volatility 10, when somebody who is making trading volatility 75 falls on profit, definitely is going to have more profit than somebody who is trading volatility 10. Likewise, when you fall at loss, so you should be able to differentiate these two. Then you should be able to stick to the one that works for you, because sticking to a particular pair makes you more familiar with the movement of that particular pair. You can easily identify areas when such pair can make a good reversal, then you leverage on. So, for those of you who are new to this platform, this is what synthetic indices is all about. There are more pairs in the synthetic indices, but we just pick few. And the major motive of this video is to just tell you what exactly synthetic indices are. So that you shouldn't, when you're talking about synthetic indices, you should see them as pairs that mimic the real world market, and they are not affected by any economic event or any other event that affect forex in the general world. And again, their movement is being programmed by a particular system with use of certain indicators. So this is why some of you or those who are new are missing it, because some people will tell you, because they say forex zone works during the weekend, they feel indices don't work during the weekend. No, Indices work every day, every time, every year. It is round the clock it is working, but there are particular points in time which is safe to trade any of them. So if you are new to this platform, you need to be very, very cautious of which one you are going to pick, when to trade it, and how to trade it. So I think this brings us to the end of this particular video. In our next video, we'll be talking about the strategies involved trading synthetic indices. So stick to this platform and then you get more info that's going to skyrocket your trading uh, uh, knowledge to make more profit. All right, cheers, guy.